Hey guys, Charles Vamadeva, Patriot Pacific Financial Corp. I'm here with a wonderful guest today, Joel Daniel, broker, Greenleaf Real Estate and Appraisal Services in Temecula?
Yes, Temecula.
You're at Temecula, okay.
Yeah, both.
Both.
Yeah.
And Joel had hit me up to talk about an extremely hot topic, which is interest rate buydowns, which are obviously very appealing in this market. You know, we're recording this in the beginning of 2023. Rates have come down a tad bit, but they're still not what they were in 2020, 2021. So, Joel, fire away. What questions do you got?
Yeah, I just thank you for meeting with me.
Of course.
I'm getting tons of questions about this, especially from out of town or out of state buyers from my YouTube channel. So I just want to be able to post this and give people the right information, in-depth information that is going to help them move forward on, whatever home they purchase. And this is definitely, from a real estate perspective, this is definitely an opportunity because in this market, you're allowed, well, not you're allowed, but you're able to ask for closing costs. And a lot of times, not like it was a year ago, the seller is willing to give you some closing costs. So, let's get into the questions. But the first question I had for you is just, can you just explain what a rate buy down is?
Sure. Let's talk about that. So I always explain to buyers, look, there's three types of interest rate. That might come across a little odd, but there's three types of interest rate. The interest rate that we call in the industry par is an interest rate that's not going to cost you, the buyer, anything, but you're also not going to get any sort of credit from the lender either. An interest rate with lender credit is exactly that. The lender might say to you, hey, here's a higher interest rate, and in exchange for that, we're going to give you X amount of monetary credit to help you cover some of your third-party closing costs. And then we've got the third type of interest rate, or third category, which is, hey, I'm going in the other direction. Here's an interest rate that's going to cost you, but you're going to get a lower interest rate. Okay, so rate buydowns are basically a situation where the lender is being given money to bring the interest rate down below par rate.
Okay. Okay, next question. How does the rate buydown actually work, in the start of the process for once you open escrow?
Okay, so first the buyers got to know, Joel, that there are two different types of buydown. One is a permanent buydown. Okay, this is where the lender is being given money to bring the interest rate down for the life of the loan. Whether it's a 15-year fixed or 20-year fixed or 30-year fixed, for the life of the loan, that interest rate is going to be what it is from day one. Then you've got a temporary rate buydown where the lender is being given money to bring the interest rate down for a certain segment of time in the life of the loan.
Okay.
Does that make sense?
Yes.
So that's a temporary rate buydown. We're going to get into the details of both.
So just a follow-up question to that, Charles, is a permanent rate buydown more expensive than the temporary rate buydown?
That is a loaded question.
Okay.
It depends, and I'm not trying to be evasive, but it depends on a lot of different factors. It depends on the type of loan that the buyer is getting, FHA, VA, conventional, USDA. It depends on market conditions at the time that the loan is being secured. By and large, we've found that temp buydowns are a better deal for the buyer. And I want to explain why that is, but I don't want to get away from any future questions you got here.
Okay. So, we'll get into that in a sec.
Yeah, we'll get into that.
Okay, so next question would be, can any borrower qualify for a rate buydown regardless of what loan they're getting? Can you just explain, different situations, but ultimately, can anybody qualify for a rate buydown?
To be honest with you, Joel, yes and no. Most lenders are going to set FICO score limits. I'll give you an example. One of the lenders that we work with as a brokerage is PennyMac. PennyMac has a pretty high score requirement of 660. There's many others at 620. Now, once you get below that FICO threshold, it becomes so expensive to do the buydown that you're going to trigger these federal high cost limits. You're going to exceed the threshold, and it just doesn't become feasible to actually do it.
Okay, then can you add on to that and give an example of maybe the type of loan or the type of person that would best be suited for a rate buy down?
Sure. In my opinion, and by the way, before I answer that, the temporary rate buy down is available for all the major loan types: FHA, VA, USDA, conventional. But FHA is the classic example, right? You've got, by and large, entry-level home buyers, first-time home buyers. They're very payment conscious, payment sensitive. And the temp buy down is great because for either the first 2 years or the first 3 years, we're going to be able to bring that payment down to make it a lot more affordable, anticipating that after 2 or 3 years, maybe their incomes are going to be up and they can afford the permanent payment, or they'll have an opportunity to refinance. The market turns in their favor and they can get a better interest rate than what they started out with.
Okay, so this might be a two-part question, but how much does a rate buy down cost? Can you go into 1 year, 2 year, 3 year, different types of loans? I don't even know if you're able. Maybe it's each individual is different, but can you do the best that you possibly can in explaining the cost of rate buy downs?
Sure.
For those scenarios.
Absolutely. So on a permanent rate buy down, where the lender's charging X amount of discount points, that's really based on the margins that particular lender has set on that date for that FICO score for that loan product.
Okay.
There's a lot of moving parts. Temp buy downs are a lot easier to figure out. So what I want to do is actually whip up a calculator here that we use. We're going to take an imaginary loan amount. Give me an imaginary loan amount here, Joel.
Okay, so let's just say $500,000.
$500,000. Gotcha. So let's say we've got a $500,000 loan amount. Let's just say, for argument's sake, we've got a $600,000 purchase price, for argument's sake, and I'm just going to make up an interest rate of 6%. Okay, 30-year fixed. Yep. So if that buyer were to get that loan, and these are just arbitrary figures, but if they got that loan today at 6%, that rate would be the same for the life of the loan, 30 years. And I'm showing on screen here that payment is $29.97. Now, on the 2-1 buy down, we're bringing...
Not to interrupt, Charles, the 2-1 buy down, can you explain what a 2-1 buy down is?
Sure. 2-1 buy down. The first year, the monthly payment's going to be based on an interest rate that is 2% lower than the standard fixed rate of that loan.
Okay.
The payment is going to be based on a rate, in other words, 4%. Because we're doing a 30-year fixed at 6%. Now, keep in mind, this is not an adjustable rate mortgage.
Yeah.
This is a 30-year fixed mortgage, and that's been a hang-up for a lot of buyers. Oh, my God, that sounds like a rate's going to go. No. This is a 30-year fixed. We're just giving you a subsidy for the first 2 years or 3 years. Okay. So the first year, the payment's going to be based on 4%. The second year, the payment's going to be based on 5%. And then after that second year, it goes up to 6%, which is the original interest rate, and you keep making that payment for the rest of the term of 28 years. Okay. Now, watch what happens. If you can see my screen, the savings, because remember, the lender's still going to get the same amount of interest. The lender's getting interest based on the 6% that applies to that 30-year fixed loan. So the lender's not really losing any money here. They're going to get their interest. They're going to get it from a different source the first 2 years. They're going to get the buyer's going to get a subsidy. So the first 12 months, the amount of interest that is shaved off, lowering the payment, is $7,328. The second year is $3,763. The total is $11,091. In other words, let's kind of bring it home here, sum it all up. On this 2-1 buy down example, the payment savings is about $11,000 over the first 2 years, and someone else is going to pay that on behalf of the buyer. Okay. It could be the seller most often. Some realtors, if they're able to, can contribute. And so those are the two that can contribute. There are rare instances with some lenders where the buyer can contribute, but in my opinion, there's really no sense in that. Yeah. Because the buyer's making the payment. So that's how the interest rate buy down works. You basically take the payment and the interest rate, you lower that interest rate by 2% the first year, 1% the second year, and the difference in interest that the lender is due is paid by a third party.
Perfect.
Make sense?
Yeah, and then do you mind just going over the payments, monthly payments your first year, your monthly payments your second year, just to give the viewers, the audience, an idea of how much 2% is really going to save them on their first year and 1% on their second year.
Absolutely. It's right here. So we started off with an imaginary 6% 30-year fixed, $500,000 loan. The payment was $29.97. Well, if we do the 2-1 buy down and the payments based on 4% the first year, that payment's $23.87, which is $610 a month in savings. Yeah. It's significant. The second year, that payment's $26.84 compared to $29.97, and that's a difference of $313. So, it does get cut in half the second year, but you're going from $610 down to that's significant savings.
Absolutely. Another good thing that I think of is, in 3 years, there's going to be options maybe to refinance, whatever the case may be, but it's also giving you 2 years to prepare for that $2,900 payment. Yes. So if these buyers are saying, I know in 3 years my payment's going to be, at the worst case scenario, it's going to be $2,900. They could start saving some money maybe for their mortgage, the difference in mortgage payment that it's going to be in their third year. It's just a good way to prepare for the worst case scenario. Now, as we talked about earlier, I do think that there's going to be an opportunity that you'll be able to refinance your third year and maybe get a lower interest rate than 6%, but it's at least giving them concrete numbers so they can prepare for the future.
Absolutely. I want to add this, and I don't think this is one of your questions, but I think it's relevant. People have asked, well, why don't we just buy the interest rate down permanently? And there's nothing wrong with that, right? That's just a permanent rate buy down. But think about it for a second. What if you, as the buyer, are the one that's choosing to buy that interest rate down? Once you give that money to the lender as a permanent rate buy down, they keep that money. You're not getting it back, right? And most buyers are not in the loan longer than 5 to 7 years. Most people relocate, they sell, God forbid, sadly, they get divorced or something happens, they relocate with a job. And so, you've gone and paid all this money out of pocket for a permanent rate buy down, but you haven't been in the home long enough to enjoy the savings.
Great point.
Whereas a 2-1 temp buy down paid by a third party, hey, that's free money for you. Someone else. And here's the thing, $11,000 in that example that we saw, that money gets put away in an escrow account. And say for argument's sake, a year in, you're like, hey, you know what? I got a job transfer. I'm going to Connecticut. I got to sell the house. You don't lose that money. That money is applied towards your principal as a principal reduction on the loan when you sell the house and you pay off the loan.
Great point. Yeah, because what is it? Every 7 years somebody moves, and then also to add to that point, you buy a permanent rate buy down. Even if you stayed in the house for 30 years, the chances in the next 30 years that interest rate is going to be below what you permanently bought it down for. So then, what's the point of even refinancing?
So you're spent all that money,
and there's no point in refinancing.
Yeah, I'll be honest with you, Joel. I have not yet seen, and if you're in the audience watching this, you came up with some reasoning that I haven't seen or some logic I haven't encountered. I have not seen a good reason yet why a buyer should not accept a temp buy down paid by a third party. It feels like free money. Hey, I'm going to lower your payment for the first 3 years or 2 years or whatever. Why wouldn't you take that money?
Exactly. Okay, next up, is a rate buy down a good option for everybody? And if not, can you explain maybe the people that it's not good for?
Good point. So if you are doing let's talk about permanent rate buy downs for a minute, right? So if you're doing a permanent rate buy down, you're being charged a certain amount of discount points, and you spend all this money, and then 2 years later, 3 years later, you up and leave for whatever reason, or you refinance that loan. Some life event happens and you're forced to refinance. Maybe the permanent rate buy down was not a good option because you spent all the money, but you didn't stay in it long enough to recoup this, the money, the savings. Temp buy downs, I do feel like in some cases it's not a good option, and that's when the seller might decide to hike the purchase price to accommodate your request for a temp buy down. And then you really got to sit there and figure these numbers out and say, wait a minute, I just went up 20 grand in purchase price. I'm buying the home for so much more in exchange for this seller giving me a temporary buy down.
Yeah.
That the math may not be in your favor.
Okay. So the only thing I can add to that as a real estate agent, you're generally what you are doing is you're asking for closing costs. So sometimes there is no option for the buyer. They need that money for closing costs. I know we're talking about two different things.
Yes.
Now, in regards to, let's just say the buyer has enough money for their closing costs. But when it comes to the rate buy down, do you qualify? Can you qualify a buyer for more? Or does it help the buyer in regards to qualifying with that early interest rate, or do they take the average over the life of the loan to qualify that buyer?
Great question. So two completely different aspects of this. One is affordability and one is qualification. And your question speaks to the qualification aspect of it.
Yes.
And the fact is that lenders, when we qualify you, we take that 30-year fixed payment.
Okay.
And we say that interest rate is what you've got to qualify with, irrespective of the fact that the first 2 years or 3 years your payment's going to be lower. We're going to qualify you based on the highest interest rate. However, from an affordability perspective, if you say, we had a buyer say, hey, I'm getting married in a year and a half or something, and my to-be spouse, we're going to form a household and we're going to have that spouse's income come in. I can afford a higher payment at that time. So if you're projecting that you can afford this is a great option.
Yeah.
Absolutely. If some life event's going to happen where, you can't afford that today, but you can a year from now or 2 years from now, a temp buy down is a phenomenal option for you.
Okay. So I know you talked about a 2-1 rate buy down, but generally speaking, can you go through and explain how long rate buy downs last? What's the minimum and what is the maximum in way of a temporary rate buy down that you would suggest?
Sure. So, there are 3-2-1 buy downs. So for argument's sake, if your 30-year fixed FHA interest rate today was 5.75, you're going to make a payment at 2.75 for the first 12 months.
Okay.
Pretty amazing. So there's a 3-2-1 buy down, and it graduates from there, 2.75, 3.75, 4.75, and then it levels off at 5.75. And if you kept that loan, that's what it would remain for the term, for life of the loan. Okay. There's 2-1 buy downs where you start off 2% lower than the 30-year fixed, and then there's a 1-0 buy down too, where you only start off, and that's not as expensive to the seller.
Okay.
Right. Now, as far as how long, I think you asked how long could you keep it for? Or how long is the buy down for?
I mean, just generally, what do you see most in the industry? Are they mostly 3 years that you see, or?
Yeah. We see the 3-2-1 buy down is probably the most common. Because it's giving the buyer the maximum benefit as far as the lowest payment. Affordability perspective. I mean, you could literally put somebody in a home and they're making a payment at 2.75.
Yeah.
That feels like 2020 and 2021 all over again.
Okay.
Permanent buy down, it is what it is for the life of the loan. 3-2-1 is for 3 years, 2-1 is for 2 years. And again, I want to reiterate that anywhere in that life cycle of that whole thing, if the market improves, the buyer can refinance out of that loan into a lower interest rate.
I think that's a really good point that maybe a lot of people don't understand is that, let's just say your third year, you're at an interest rate that, it's the last year of the buy down, and rates are actually lower than the buy down rate at that point. They can still refinance and do their 30-year fixed on that lower rate.
Absolutely. I think that's a great point. And again, I want to cross-reference with the permanent buy down. You give that money to the lender, it's gone. The lender took the money, all of it, right? And if you have an opportunity sooner than you expected to refinance and drop that interest rate, you're not getting that money back that you paid in. However, on a 2-1 temp buy down, that money's tucked away in an escrow account. and it's dispersed as needed. And like I said, if you have an opportunity to refinance and you're only 6 months in, a year into a 3-2-1, the leftover excess, boom, it's applied to your principal balance.
Oh, okay.
Yeah.
That's a good point.
Yeah.
My next question would be, what are the risks to the buyer of a rate buy down? It doesn't sound like there's many risks, but I just want to put that out there so everybody, they understand and they know that they're safe and this is not something weird. So are there any risks to these things?
I would say there are. However, in a 2-1 or a 3-2-1 temp buy down situation, it's really hard to put yourself in a dangerous position because a third party is paying for you to have a lower payment.
Yeah. And
that money is tucked away and you can get at it. You're not going to put that in your pocket, but it's applied to your principal balance in the event that you pay off the loan early. Mm-hmm. The only danger I would point out is, I think I mentioned earlier, is if the seller or the seller's agent or your agent is not as savvy and maybe they go hiking the purchase price excessively to accommodate your buy down. Now the impact of the buy down isn't as much.
Okay.
You're paying too much for the house to get this 2 or 3 year relief.
Yeah.
I think that is a risk, but I haven't seen that much.
Yeah. And from a real estate standpoint, mm-hmm. in this market, I want buyers to understand that, if you're patient and you're willing to walk on a property, that's really not going to happen because, yes, there are properties right now, and I just finished the video, today. There are properties that are selling, specific properties in Temecula and Murrieta. But for the most part, the sellers are not having multiple offers on their property. So if they have to come up with $10,000 or $11,000 to give the buyer a rate buy down and they don't want to do it, if you're okay with walking and finding another home, I promise you in this market, they're going to be able to find another home that the seller will do that for. So
that's a great point.
Yeah.
Great point. The buyer's got options.
Yeah. Just don't fall in love. Try not to fall in love with one single home. That would be my only point.
That's terrific. It's a great point.
Okay. So Charles, my next question, can the rate buy down be combined with anything else in the offer that I might make that could be beneficial to the buyer?
Yeah, absolutely. If you really stop and think about it, the rate buy down is money that's being acquired from the seller for a very specific aspect of the transaction. Mm-hmm. Right? We're gonna funnel this money to buy the interest rate down for X amount of time. We haven't talked about the fact that the seller can still contribute towards your customary closing costs. Okay. Escrow fees, title fees, appraisal, lender charges, tax and insurance impounds. Mm-hmm. The seller can pay all of that. Okay. So potentially, and we're seeing it, especially on FHA VA loans, where the buyer is literally not paying any costs because the seller is absorbing all of it. Plus, they're having the seller pay for them to have a lower payment for 3 or 2 years or whatever. Mm-hmm. So that's a big deal. You combine the two. Now, I do want to say this, a little disclaimer. Each loan product has its built-in limits on how much the seller can contribute. Okay. Conventional, for example, if the loan to value is above 90, the seller can only contribute 3% of the price of the home. Okay. Right, 90 or below, you go 6%. FHA is 6% across the board. VA is a little bit of an anomaly. I don't want to get into it. We'll be here all day. VA has a concept where the closing costs the seller can contribute. There is no figure. It's unlimited.
Wow. Okay.
Most lenders say 4%. It's really not. It's unlimited. But the concessions are 4%. Okay. So potentially you could have an 8% seller contribution.
Wow. Okay. And just to add to that point for buyers, the one thing with this market that we're in right now that you have to understand is because we've had such a high market over the last year, the appraisals haven't caught up to maybe where where maybe a home is actually worth in this market. What I mean by that is you could theoretically ask for a rate buy down. You could ask for a closing cost, and we can still get the appraisal in at value. A lot of other times in markets, one of the biggest things why sellers don't like doing these rate buy downs or don't like giving the closing costs is because what if the appraisal doesn't come in?
Sure.
Now they're not only on the hook for the closing costs, but if they could lose $10,000, $15,000 off the purchase price if the home doesn't appraise. But in this market, we're still seeing because of where the market is, there's not a lot of chance that these appraisals aren't coming in, for the most part.
Great point.
Yeah.
Great point. Really what we're saying is, forgive me for digressing a little bit, is this is an incredible opportunity for buyers to get in and get a good deal, isn't it?
Yeah.
I mean, sure, you're not seeing 2.5, 30-year fixed anymore, but you can get a great deal on a home, and you can really get the seller to give up a lot. Yeah. And you're doing it.
Yeah, exactly. I mean, I can't remember.
Yeah.
I think maybe the last time that I had, regularity in getting closing costs accepted was like 2013, 2012. Wow. It's been a long time that I can remember that, closing costs were just customary, being asked for, and they were getting accepted.
Wow.
Yeah.
Good stuff.
Okay, guys. So final question for Charles. If you have further questions, he's just going to go in, explain, just tell them a little bit about yourself, and to contact somebody to figure out if this is right for you, if it works for you. I've been working with Charles for over a couple years, I think now. He's an amazing lender here in Temecula. I strongly suggest that if you have any further questions, reach out to Charles. Can you just, tell him a little bit about yourself?
Yeah, sure. Thanks, Joel. Yeah, I actually run the company here, Patriot Pacific Financial Corp. I've got a big team. We're successful because of the team, not because of me. I'm not a one-man show, thank God. But we do all of the loan types, FHA, VA, conventional, USDA, all of that. And what I love to do when I'm talking to a buyer is give them options. Right? You don't want to have something shoved down your throat. Hey, this is it. Take it or leave it. No, we'll sit there with you and we'll do a Zoom meeting. We'll have you come in and sit down with us and we'll lay it out on the table and say, hey, what is your situation? Let's look at 2 or 3 different options with and without buy downs, with and without a temp buy down or a permanent buy down, and really put you guys in a strong position where you feel like you know what your options are and you're confident that this one that you picked is the best one for you. That I will do for you. And all my contact information is on the screen. PatriotPacific.com, Charles Vamadeva, 951-551-7633. And I'd love to work with you.
All right. Thank you very much, Charles.
Thank you.
Again, thank you for all my subscribers, YouTube, Exploring Temecula. And until next time, see you later.